Good morning. It is a real pleasure to welcome you to what is probably the first CEPR virtual breakfast meetings. We used to do breakfast meetings for launches, but of course they had the advantage that you could actually have breakfast. You can have, of course, your coffee and your breakfast. I hope during this hour we will also nourish you in other ways. Let me give a brief introduction to what we are launching today and its history. So this is a project which has a lot of history. We are talking about, after all, the historical foundations of the EU, no less, that were put down in Maastricht. And they were put down with a certain worldview of what can happen in the world and its risks. It's the fiscal policy framing, the monetary policy framing and institutions, their interaction or separation, their economic effectiveness in the wake of big crises and major stress tests, as well as their flexibility to adjust in practical terms, but also in legal terms. This is what is at the core of what we are discussing here. Certainly one thing to remark at the beginning is that the economic framework of the EU has been remarkably resilient and adaptable to a changing world and to unforeseen risks. But it did have to be stretched in legal terms, and it had to be amended, and additional institutions had to be created in the wake of the global financial crisis. And now, post-COVID crisis, we have found ourselves again in a situation where an unexpectedly large shock has happened. But in the original Maastricht, the idea was these kind of shocks could not happen really in our regions. They were more typical of more vulnerable regions and poorer countries. Second, in terms of history, is this project and its relatives have a long history at CEPR too. So the CEPR founding fathers, and yes, they were all fathers, cared deeply about the construction and integration of Europe, and analysis and advice was one of the hallmarks of CEPR since its foundation 35 years ago. After the global financial crisis, CEPR again became a venue for a group of concerned economists to gather and come together with joint proposals for reform, dealing with legacy debt, dealing with the doom loop, banking union, macro policy. And a series of reports were issued in different compositions, but with some of the players that are still contributing today. One of them, and actually the latest in that series, was the so-called 7, or what was then called the 7+7 report, all economists from only 2 nations though. This time is different, and it's different in many ways. So this crisis was different. As we know, it was larger in economic terms, it was faster and deeper than anything we've seen in peace times. But the European political response was also larger, deeper, and faster. As a result, between the ECB and the new generation EU, we have a situation where a lot of confidence has been created in the resilience of Europe, beyond just providing a safe asset. It has also made existing assets safer. The new situation, however, that we find ourselves post-COVID is much further from the mark in many ways. The most remarkable one, or the most notable one, is the 60% debt limit, which no longer serves really as a reference point for any kind of medium-term development. And the monetary policy has been repeatedly challenged legally, as we all are aware of. So this time is different also from our point of view and our group. About 8 months ago, we came together again and wondered what is now left, what do we need to do post-COVID? And in particular, one of the questions was, can we go on without treaty change? Can what is economically necessary be done within the existing legal constraints? And this time was also different in the following sense. We cooperated with lawyers ex ante. In my own history, I have often had the experience that economists put out big proposals and lawyers tell them this is all not possible. Forget it. Now we wanted to see ex ante what is possible and what is not. So we gathered a group of about 25 economists and lawyers at the European University Institute in Florence in last September in a physical meeting and had a very, very fantastic 2 days of intense interaction discussions. And the continuation of that is what you have in front of you today, what we are launching, a policy insight on what is needed economically, what is possible legally. All of this under the absolutely outstanding leadership of Jean Pisani-Ferry, who has been a relentless driver of all of us and has made it possible that we are able to bring this to you before Christmas as hopefully part of your key Christmas readings. So with this, I will hand over to Jean, who will moderate, will introduce, moderate, and make sure to keep people on time. And you will also be able to ask your questions. He will take over from here. Thank you very much, Jean, for everything. The floor is yours.
Thank you, Beatrice, but you should have emphasized that it was really teamwork throughout. And that was a very good experience, I think, for all of us, especially to work with our lawyers colleagues. The way we're going to present this paper is by taking the main points one by one. So we start with Lucrezia on ECB and the policy mix. Maybe I should introduce the panelists. So we have three of the authors with us today, or four with Beatrice. We have Lucrezia Reichling from the London Business School. We have Armin Steinbach, who is the lawyer in the team today from HSA, and myself from the UI. So we start with Lucrezia and Armin, and I'll continue also with Armin on the two other topics. Lucrezia.
Thank you, Jean. So as we all know, the EMU is an asymmetric federation with one monetary authority and 19 independent fiscal authorities, and is guided by a principle. So the ECB is independent with a strict mandate of price stability, and there is an implicit coordination rule between the monetary authority and the fiscal authorities. So each member state take monetary policy as given, and undertakes fiscal stabilization policy subject to a set of fiscal rules. And the Stability and Growth Pact was created to promote sound public finances and operationalize the prohibition of excessive deficit. Now, this kind of setup was established to address two potential problems: fiscal dominance over monetary policy, which would threaten price stability, and moral hazard in the form of fiscal free riding by one member state on the others. As a result, the Maastricht system does not just seek monetary dominance, but separates monetary and fiscal policy much more strictly than in other jurisdictions. Now, there are four treaty provisions which are relevant in this context, beside the article that states the independence and the price stability mandate. The first one is the prohibition of monetary financing. This is Article 123, which provides an extra bulwark against any pressures that may lead to public debt monetization. This was initially translated into excluding outright purchases of government security from the ECB toolbox. But as you know, since QE and now with the strategy review, these operations are part of the normal toolbox of the ECB. So this raises the questions of the meaning of the no monetary financing provision. The second treaty clause is the no bailout clause, which prohibits the EU and its member states from assuming liability for the debt of a member state. The third one is financial independence. The ECB is not just independent, but it has to be financially independent. And so the statute provides financial arrangements to keep the ECB, the financial arrangement of the ECB separate from the EU. The ECB has its own budget, its capital is subscribed and paid up by the euro area national central banks. Now, although it is understood that the national central banks must provide capital, adequate capital to the ECB, and the national treasuries should capitalize in an adequate way the national central bank, the rules on capitalization, the distribution of senior agents, risk-sharing within the euro systems lack clarity. And finally, there is the principle of proportionality that requires that the content and form of policy intervention at the EU level should not exceed what is necessary to achieve the objective of the treaties. Now, the experience since 1999 has shown that important aspects of this framework have not passed the test of time. And first of all, there are circumstances in which active fiscal policy is more effective than monetary policy. So we want to, maybe provide for mechanism of coordination. Second, with the increased size of the Eurosystem balance sheet, there are also increasing risk in the balance sheet, and there are perhaps concern that there is inadequate protection of the ECB financial independence. So the rules on capitalization must be clarified. The treaty says that the national central bank should be adequately capitalized, but it does not specify the process for ensuring that they are. The third issue is that an excessively narrow interpretation of the prohibition of monetary financing and the principle of proportionality could limit the scope of the ECB action and impair the ability of the ECB to pursue his primary mandate of price stability. This, for example, has to do with, a set of limits of safeguards, if you want, that the ECB has set to, in the way in which, it does the purchases of assets in different proportion in different countries. So these rules, these safeguards, are there in order to protect the ECB for possible, legal action, but in some circumstances may limit the effectiveness of its policy. The same thing for proportionality. The non-standard policy have distributional consequences, as we all know. But the fact that they have distributional consequences have been used to say that actually this break the principle of proportionality, and therefore the ECB should not pursue those policies. So again, this is an argument that may inhibit the ECB to pursue the policy that it needs to pursue for price stability.
If you may speed up a bit.
Yeah, so there are then 4 reform directions that have been designed to cope with the problems that I briefly outlined. The first one is strengthening the fiscal support to monetary objective. This may happen through, for example, a modification of the fiscal rules, or to create a central fiscal instrument. Jean will talk about that later. The second is making room for monetary and fiscal coordination, either in the form of a soft coordination mechanism between the monetary and the fiscal authorities, or through more radical solutions, as for example, helicopter money. The third reform direction is, to think about strengthening the financial independence of the Eurosystem by equipping it with callable capital. This, for example, could envision the creation of a fund through which the Eurosystem would manage sovereign purchases, as it has been proposed by a recent CEPR report on the ECB strategy. And the fourth reform direction is disregarding safeguards that stand in the way of effective monetary policy, in order to remove ambiguity and strengthen the legal certainty. So I will then give the floor to Armin, who would comment on the legal aspect of these reform directions.
Yes, thank you very much, Lucrezia. You mentioned and touched upon already the legal dimensions, and so I can be very, very short in adding a few comments to this, also because 8 o'clock in the morning is not the good time for our participants to hear a lot about legal issues. I want to be as concise as possible. So what is true, when we entered the legal exploration of all these economic proposals that we made, we had to be aware of the peculiar treaty design in relation to monetary policy and fiscal coordination, which, as Lucrezia mentioned, is delicate in the sense that the treaties are designed in strict separation of these two policy areas. And over the last decade, over the decade of financial crisis, sovereign debt crisis, there were a number of legal controversies, both within legal scholarship as well as between courts in the European Union, between member states, and especially between the German Constitutional Court and the European Court of Justice in Luxembourg. And these controversies surrounded about the interpretation, especially about the no bailout clause, Article 125, the ban on monetary financing, 123, and the proportionality assessment. In a nutshell, historically, we started with the interpretation of the no bailout clause, which was especially concerning the European stability mechanism, and the question whether such instrument is in line with this no bailout clause. And in that particular ruling by the European Court of Justice, the court said, well, if there is conditionality attached to such help, fiscal help from one member state to other member states, then it's fine. We then moved on with unconventional monetary policy, and this led to another saga of legal controversies and legal disputes based on the ban on monetary financing. And there we saw a very confrontational, you may say, understanding of how this rule should be interpreted. You have a very narrow reading by some courts of the member states, which are keen about attaching very strict and mechanical safeguards to unconventional monetary policy, especially to bond purchases. And then you have a jurisprudence by the European Court of Justice, which rather looks at the effect that such measures would have. And last but not least, the proportionality, which is a constitutional law principle, which applies in most of the constitutional orders in the European Union, but also beyond, which basically says that policy measures must be both suitable to reach a given objective, and it must be, second, necessary to reach this objective. And necessary means there should be no other equally suitable mean available. And there again, some have this interpreted very narrowly in looking, as Lucrezia mentioned, also at the distributional effects. And you may have heard about this judgment of the German Constitutional Court, which said, well, ECJ, European Court of Justice, your ruling was wrong because you did not ask the ECB to come up with a fully fledged balancing and weighing of the distributional effect. Now, we think that this narrow understanding, both of the ban on monetary financing and proportionality, is not a proper legal interpretation of the given rules. And therefore, against this background, we think that the ban on monetary financing should be interpreted in the spirit of the basics of the treaties, which means that we should abandon the benchmarking of mechanical safeguards in relation to unconventional monetary policy, and rather look at whether given monetary policy measures is actually driven by monetary policy intentions and objectives. And second, that if such measures are taken, they should make sure that the budgetary pressure on member states, which is the core rationale of both the no bailout clause and the ban on monetary financing, that this budgetary pressure is maintained. So this is what we propose to on the side of legal interpretation of given rules, and then looking at what Lucretia mentioned, potential coordination mechanisms. We are fully aware that independence is a core pillar of the legal setup of the monetary policy, and independence has at least two dimensions. The one is financial independence, meaning that the ECB has to be equipped with the proper capital to perform its functions. And the second is procedural and substantive independence, meaning that the ECB cannot be subject to instructions or binding commitments from other policy makers, from the fiscal side or from other side. So this leads us to say that while the ECB cannot enter into binding agreements with other policy stakeholders, but it can clearly enter into soft kind of coordination mechanisms, in the sense that it can enter into dialogues, in unbinding dialogues. It can establish a common analytical basis with other policy makers. So mechanisms or coordination mechanisms that are unbinding and soft in nature. I will leave it here.
Thank you, Armin. Thank you both. So we're moving to the two other themes of this paper. One is the fiscal rules, and the second is the legacy of the COVID recovery instrument, what's called as Next Generation EU, NGEU. So on the fiscal rules, and really to echo what was just said, we are not debating whether the rules are too stringent. We're not debating even most part whether we need rules, but we're debating what are the appropriate rules in this kind of setting we are in. And we start from the observation that there has been a trade-off since the start of Maastricht. And this trade-off is between, on the one hand, making sure that we have rules to mitigate the risk of debt crisis and the risk of fiscal dominance that we just alluded to by discussing the relationship between fiscal and monetary policy. And second, that there needs to be room for countercyclical policies. So this is an old trade-off, and the EU has been struggling with it since the start, and this is why there have been so many reforms of the Stability and Growth Pact and the rules. Now, there is agreement today to consider, I'm not speaking of the group, I'm speaking more widely, that the rules are too complex. I think everybody now recognizes that the attempt to write a complete contract has led us to something that's undecipherable for even policymakers. There has been too much fine-tuning, and there is sort of too uniform a view of the differences among member states. So that's the consensus. But there's three issues really on which there is discussion. One is the reference value, so 60% and the 3%. Do they make economic sense or not? And we think that they don't make economic sense for each and every country, that reference values have to be based on an assessment of what is a requirement for fiscal sustainability, and the same number cannot apply to all countries. Not only because initial positions, current positions are different, but also for more fundamental reasons having to do with growth rates, with the ability to post primary surpluses, etc. The second point we started with is the fact that top-down differentiation, which is a possibility once you recognize that there are differences across countries, top-down differentiation would create even more complexity in the system, because you would need to have rules for all sorts of cases on top of the rules we have already. That's the second point we started from. And the third is that the cost of having a rigid system or not leaving enough room for countercyclical policy is higher nowadays than it was at the start and even 10 years ago. And this is because of the low level of equilibrium in interest rate and the risk of ineffectiveness of monetary policy, which calls for more room for fiscal action. So the directions for reform we're putting forward starts from the notion that there needs to be a reduction in complexity, that sustainability remains paramount. And also we build on the technical agreement there is that once that anchors have been defined, then implementation should really be based on an expenditure rule. So the way it should translate into an operational guidance for fiscal policy is through an expenditure rule. Then we move to the options, and we consider 3 options. The first one is the one that has been put forward by Blanchard, Leandro, and Zettelmeier, and it's a radical option that proposes to replace rules by standards. So the standard would be, the definition that policies have to be sustainable with a high degree of probability, and that would be used as a yardstick for assessing the policies of the various member states. And they could be, therefore, in the most radical version of their proposal, they could be a change in the enforcement procedure and move to a judicial enforcement instead of the procedure of excessive deficit procedures through the Council. So this would require a treaty change. Now we're considering also other options. One is an option Philippe Martin, who is also a member of the group, and I, together with Gabriel Arago, have put forward, which is the idea of having country-specific debt targets. So the requirement to sustainability would be uniform, but it would translate into differentiated debt targets depending on the country. And the initiative for proposing those debt targets would come from the countries themselves. So government would say, this is my debt target for the medium term. This would be assessed by an independent fiscal council at national level. This would be assessed by the Commission. This would be all done on the basis of the common methodology agreed by the ECB, proposed by the EFB and agreed by all the participants. But then on this basis, you could have differentiation with the same aim, but different numerical targets. And the third idea we're considering, there are various variants. One is to introduce more flexibility through multi-speed adjustment that has been proposed by the European Fiscal Board. One is to sort of more rebalance the criteria in the implementation of the excessive deficit procedure. One is to make more use of the escape clause. So there are various proposals, there are various options to go in the same direction. I would say there is a radical option. There is the option that requires a structural reform of the system, but importantly without a treaty change. And I think Armin will explain why. And there is a third option, which is essentially to introduce more flexibility while keeping the rule mostly unchanged. So let me stop here and ask Armin to explain what's a legal requirement.
Yeah, when exploring these reform options that John just described from a legal perspective, we had to face 3 particularities of the fiscal rules in the European Treaty. The first is that it's a body of legal rules that is extremely detailed in the European Treaty, and that is very uncommon for treaties. Treaties normally come up with vague and very general rules, such as the ones we discussed before, a bailout clause and monetary financing. But the fiscal rules are very detailed and meticulously described in the European treaties, and they have a very strong political connotation, meaning that the European Commission and the Council have a very strong role in the fiscal surveillance of the member states. The second particularity is that you have a strange mix of rigidity and flexibility. You have the rigidity in terms of the reference values that are uniformly applicable to all member states, the 60% and the 3%. And you also have this famous 1/20th rule, which obliges member states under certain conditions to move to their 60% debt ratio by 5% each year. This is the rigid part, and then you have a flexible part where the Commission over the years tried to instill some flexibility into the rules by allowing structural reforms, by allowing investments to some degrees. So you have this mix of procedural over-complexity and substantive under-complexity. And third, the third particularity is that that the SGP, the Stability and Growth Pact, has been a constant construction site. While primary law has been largely unchanged since the inception of EMU, the Stability and Growth Pact has been amended every couple of years, always with a different intention to make rules either more flexible in terms of the stabilization function it should perform, or in order to make enforcement stricter. So there were a number of changes. Now, from a legal perspective, we were asking the question, how can we deal with that rigidity? And how can we overcome the rigidity on the debt ratio reference value, but also on the deficit value reference value, and to make debt sustainability the benchmark rather than fixed reference values. And one avenue that we explored is, let's just use the flexibility which is already in the treaty, and indeed for the Commission, when it decides on whether an excessive deficit procedure should be launched, it can take into account so-called all other factors. And all other factors is a very legal term, and you could put everything into this reference, can count as factors many different things. For example, country-specific speeds of adjustment is something that you can certainly take into account in this context. However, this given flexibility in the rules have limits, and obviously, as long as the 60% and the 3% are in the treaty, they are the main benchmark, and you cannot easily deviate from them. We then explored what other legal amendments are possible to abandon the strict reference values. And for that to explore, you have to be aware that there are at least three ways of how to amend treaties. The first way to amend treaties is the classical way, that a European Convention must be convened, an intergovernmental conference must be convened, which is a very complex procedure. A second way to amend the treaties, which is a bit less cumbersome, is that there must be unanimity in the European Council on the change of a specific treaty. And for example, the ESM, the European Stability Mechanism, was introduced on basis of this procedure. However, you still need ratification in all member states. And the third avenue to amend the treaties is a so-called simplified procedure, which is a procedure which is enshrined in the treaties and foreseen by the treaties. And this simplified procedure can be used to to change the uniform application of the reference values, because the reference values, they are not written directly in the main text of the treaty, of the primary law, but they are part of a protocol which is attached to the treaty. And this protocol you can change much more easily than a regular treaty amendment. And this works through unanimity in the Council, so not in the European Council, but in the Council, after consulting the Parliament and the ECB, and especially without ratification. So it's a fairly manageable and easy way to amend the treaties, and especially amend the protocol and replace the protocol, which then would allow to not anymore have 60% and 3% as the main benchmark for the fiscal surveillance. Last point is that I want to mention, as Jean mentioned, the various the broad width of proposals that are on the table. There are proposals, the one from Blanchard and Leandro and Settelmeier, which also want to address the enforcement procedure. The enforcement procedure in the fiscal rules is such that the European Court of Justice does not play any role. As I mentioned, it's a very political process. And unlike in other areas of EU law, the European Court of Justice is out of the game. And this proposal obviously wants to strengthen the enforcement mechanism by integrating the European Court of Justice, which I think is a very interesting and good idea. However, such proposals, such changes to the architecture of the fiscal rules would clearly require treaty changes. And I will leave it here at this point.
Thank you, Armin. In other words, except for this proposal, what's required is a political consensus, not a treaty amendment. So political consensus is important, but the question is more political than legal. Let's move to the last of the three topics we're addressing, which is the legacy of the Next Generation EU initiative. So this initiative changed really the debate on the future of the European budget, EU budget, and actually also what at some point was a discussion on the euro area budget, because it really broke political taboos about transfers, about own resources, but also it introduced a true innovation, which is that before the Next Generation EU, it was assumed that because the EU budget has to be in balance, there was no possibility for the EU to borrow to finance initiatives. So the EU was able to borrow, to lend to, for example, countries outside the EU or member states which are not members of the euro. That was done for assistance program to Central and Eastern Europe in the past, for example. But it could not borrow to finance initiatives that had a budgetary character. So the EU introduced this NGU as an off-budget exceptional instrument. So it's not technically part of the budget, although the transfers obviously have a budgetary character. It's a very complex instrument in the way it's constructed. So there's this innovation of the financing of off-budget transfers through debt. There is this political decision to increase, in order to back up this commitment, the own resources with the direction of raising new genuine own resources, but also as a fallback solution to increase the contribution by the member states to the EU budget temporarily in order to pay back this debt. And there is also the creation of a new instrument that's called the recovery instrument, which is a permanent instrument, which actually makes it possible for the EU to change the way it interacts with member states. So let's take the example of the structural funds. Normally with the structural funds, there is an agreement on what the structural funds are for. And the EU, in very detail, checks the way the structural funds are spent, but doesn't check so much the environment in which this spending takes place. And the recovery instruments is just the opposite. There is more flexibility as regards the way the money is spent, but more conditionality as regards the reforms, the other policies that are put in place as an environment to this investment. So when in the EU, for example, transfers finance investment in the green transition, there is a certain number of what's called milestones, that's legislation or targets, that quantitative target that are part of the contract. And the conditionality is more on this milestone and target than exactly on which is the ultimate destination on a case-by-case basis of the money. Clearly, there is assessment on the integrity of the process, but the EU is more interested in the policy contribution than in the detail of how it is spent. Now, that's what we're starting from. And the question, obviously, for the future is, will it be a complete one-off or will there be a legacy? So the first question perhaps is, will the debt be repaid, or will it be rolled over? There is a very strong appetite in the market for this debt. All the debates there had been about this, the European safe asset have in a way been solved by this issuance of EU debt, which is sold very well on the market. So the question is, what would it take to decide when the time comes to, and it's certainly not now, but it's going to come relatively soon, as market participants want to know whether these instruments are sort of, the financial instruments are permanent or not. What will it take to take the decision either to reimburse, or to reimburse partially, or to roll over this debt? And essentially, it's a political decision, because there's a date which is put in the agreement by the Council, and this date can be changed. Now, the second question is this machinery for the relationship between the EU and the member states. What will be the legacy of it, and will it be used in other fields? And what we're saying is that it is likely, and it is an interesting evolution of the EU system. For example, it could be used for the next generation of structural funds. For example, it could be used if the EU agrees on a particular treatment of expenditures having to do with the green transition in the reform of the Stability and Growth Pact. This is not something we discussed explicitly in our proposal on the fiscal rules, because our proposal was centered on the issue of sustainability, on the core issue, but certainly it's part of the discussion. And you could imagine that the conditionality on how a possible flexibility given for expenditure investment for the green transition, the way it would be managed would be something that would build on the experience with NGU. So conditionality on the use of the money. So that's the second question. So we think that there is a potential for changing a number of things, relatively important ones, in the way the EU functions. And now the last question, and perhaps one that people are most interested in, is will there be some sort of repetition of the NGU? And really, what we're saying is that NGU is not the basis for a permanent budget. That's very clear. So that would be illegal. And if and when a permanent budget for the EU, with the possibility of borrowing, with the possibility of increasing revenues, if it has to be decided, this is a treaty reform. This is a fundamental decision, has to go through a treaty reform. What we're saying is there is a possibility of building on the NGU initiative, first to address other shocks, other priorities. You can think of, in a rough environment, you can think of emergencies that require mobilizing resources. You can think also on major priorities that have to be financed over the medium term. So what we're saying is that in order to make sure that if it has to be repeated, it's not a way of moving off budget, that's something that should be in budget. There needs to be a clear definition of what are the kind of exceptional conditions in which such an instrument could be mobilized, first. And second, what should be the procedural requirements to activate a mechanism of this sort. So what we're saying is that under those conditions, this would be desirable to establish a sort of standing facility that could be available if conditions justify it. And what Armin will say is how it can be done within the framework of the current treaty. So again, building on the legal construct of the NGU, which is quite special, and what would be the limitation that to ensure that it's not becoming sort of a way out of a normal procedure for the budget.
Yes, I will briefly limit myself to dwell on the issue of repetition of NGEU, and I think the legal perspective is at first glance a bit sobering and maybe dissatisfactory for all those who interpreted the Hamiltonian moment very widely and very passionately. Because from a legal perspective, NGEU does not grant the Union new taxing powers. It does not create permanent resources. It does not change the EU budget in its fundament. It does not change the rules governing EU public finance. So it's really a legally, politically, institutionally without precedence, and it's not a precedent for borrowing capacity. Now, and this is so because of the peculiar edifice legal edifice of NGEU, which basically stands on 3 pillars. The first pillar is the own resources decision, so the decision by EU member states to lift the own resources in order to generate the revenue that is necessary to repay the debt assumed under NGEU until 2058. So this is clearly a political and unique decision. And if you read the legal text accompanying this decision, the exceptional character and the temporary character is clearly spelled out. The second pillar bearing NGEU is Article 122, which is the core legal basis of this whole project, which is the solidarity clause, which basically means that under certain circumstances, the so-called no bailout clause, about which you already talked, does not apply, but allows financial assistance to be granted to some member states if they are hit by exceptional circumstances. And the treaty parlance is talking about exceptional occurrences that must occur in order for solidarity financial assistance to be allowed. And then the third pillar on which NGEU stands is the Recovery and Resilience Facility, which is based on Article 175, and under which, as Jean already mentioned, has been built a very novel system of conditionality, of connecting financial resources to conditionality from the European semester, from the country-specific recommendations. So it gives the European Commission a lot of leverage to implement its initially non-binding European semester by tying it to financial resources. Now, this very sovereign view is somehow changed if you look carefully on what is the temporary part of NGEU and what is the more permanent part. And the temporary part is clearly the funding dimension. Yeah, the funding has been exceptional and temporary by the lifting of the ceiling of the own resources, but the permanent part is the facility which is there. And what we learned from the NGEU, that the EU has the legal basis to organize a facility that has macroeconomic functions in the way that it can allocate financial resources according to needs across the European Union. And I think this is, we have a very solid legal basis to do so. And I think this is something to build on. Now, how can we build on this in future within the confines of the treaty? Is again, Article 122 might play here a central role, the solidarity clause, which would allow for a design of facility that does not install permanent transfers moving between states, but rather functions as an insurance kind mechanism, in the sense that it is only triggered by exceptional circumstances that justify a solidarity exception. So in a nutshell, it would mean that, as Jean has explained, one would have to define procedurally and substantively what are the triggers, what are the procedures that justify exceptional circumstances, and if such circumstances occur, a standing facility that is funded by resources that have obviously been have to be politically decided on, could then function as an allocation mechanism in the spirit of an insurance mechanism. I leave it here for now.
Okay, thank you, Armin. 2 words of conclusion, and then we move to the Q&A. The way we started is really, we started from the observation that the system is increasingly stretched by the attempt to respond to pressing challenges, to pressing policy questions, without digging deep enough in terms of whether the principles, the very fundamental principle upon which the EMU is built, have to be interpreted or changed or clarified. And what we're saying is that this sort of case-by-case approach is risky because it obviously opened the way to legal challenges, and these legal challenges can give rise to political controversies, and all that creates uncertainty and unpredictability of the system. And inevitably, when questions arose, there was an urgency and there was a need to respond. But we're arguing that clarity has value, and including has economic value, and that time has come to provide more clarity. So the question, and I'm answering here also a question by Shane Vallée in the Q&A, is, does it require changing the treaty or not? We started without a sort of a constraint on that. We started by asking ourselves, what's the state of play? What do the lawyers say on the degree to which the system is stretched? What do the economists say on the degree to which rules have to be changed? And what the answer to that? And our answer, I think in a nutshell, is we're facing more political constraints than legal constraints. And therefore, quite a lot can be done within the confine of the existing treaty without without changing the treaty. Now, we don't exclude that. For example, we're saying quite explicitly that if we want to basically change the function of the EU budget, this requires a treaty change, and this is a political choice, and then a legal transformation. But that on the 3 topics we discussed, so the policy mix, the role of the ECB, the policies of the ECB, and the policy mix, on the fiscal rules, to the extent we don't go for the sort of radical option of Blanchard, Leandro, and Zettelmeier, and on some important legacy for NGU, short of transforming it into a major reform of the EU budget. This can be done within the confine of the treaty. So we think these are feasible reforms. And these feasible reforms, they should be contemplated now. So there is argument exiting from the COVID crisis, whether it's the right time to reform. We think it is. We think that some people say, basically going back to the core of the discussion of the fiscal rules, say, okay, fiscal rules, there's flexibility, NGU is in place, so there's no urgency to reform. What we're saying is that the problem is not so much flexibility, it is clarity, that the NGU probably, there needs to be time to observe what the outcome of NGU before repeating the experience possibly, but that this should not be a reason not to consider the option and the legal means to do it. So we're saying that time to discuss the direction for reform is now. Time for reform should come not too long thereafter. And therefore, we are proposing to start with sort of building consensus on the situation and the direction. That would be the European Council. We are proposing to agree on the direction for reforming the fiscal framework within the Eurogroup before the general escape clause is deactivated normally at the end of 2022. And then we are saying also new legislation should be considered within this parliament, so before the end of 2023, because 24 is time for campaign. Let me stop here. We have already quite some question. There's one by Claudia Diaz-Suarez, which is about the question of assessing the intention of the ECB, saying that it's practically difficult to assess the intention of the legislator in the field of environmental taxation. So applying that to the ECB. How would you frame such an exercise in order to overcome the practical difficulties? Perhaps for Lucrezia and Armin.
Yeah, I mean, I think that one of the things that we say in our piece is that the ECB should just explain the rationale of its policies, and it should be up to the ECB to, to explain what it's doing. And we don't envisage any, additional framework for that to take place. I mean, I think basically this is already what is happening. And I think that this is good enough, okay, provided that the ECB fulfills its mandate of price stability and explains that, what it does is, to target its primary objective. It's not up to the Court of Justice to quarrel with what is a substantial and economic argument.
Yes, I add one comment to this. It's a very good question, Claudia. But courts always struggle with examining what is the objective of a policy measure. So it's not something particular to monetary and fiscal issues, but also in other fields of law. Now, what our main point is here, that the analysis of whether a measure violates the ban on monetary financing or the proportionality should not look so much at the nature of the instrument, which, as some say, well, unconventional monetary policy is not the typical instrument of monetary policy and therefore should not be considered monetary policy. No, we think this approach is wrong. Rather, it should focus on the objective. And when it comes to court, obviously the ECB, as well as any other policymaker whose measures is before court, must make its case plausible. It must demonstrate why and justify and reason why it believes this measure ABC, these measures ABC, are monetary policy measures and contribute to monetary policy objectives. So it's a matter of plausibility and arguments that the ECB would have to make before the court, and has done so successfully actually in the past.
Thank you. There's a question by Edwin Ward on doesn't less predictable fiscal policy only make certain risk repricing by financial markets more likely? I don't think we're proposing less predictable fiscal policy. What we're saying is that there needs to be a differentiation of the targets depending on criteria such as, the initial debt level, but also the growth rate, which has a major implication for sustainability, the ability to record primary surpluses. And so, again, in the mechanism we're proposing, this would start from the member states themselves, but they would set a target, and those targets would then become an anchor for fiscal policy. So it would not be a less predictable fiscal policy. There's one question, I don't know who should answer that, commenting on the public-private partnership for financing, like the one proposed by the new German coalition, bearing in mind that it has happened in individual states in Germany, like Hesse. So perhaps the German among us should say a word on that. But it was really not part of our report.
It's true. It's not part of our report. Bernard, still a good question. Thank you very much. Well, in principle, it's a matter of the mechanics of the fiscal rule. Public-private partnerships obviously is not as such prevented or prohibited by the fiscal rules. The only question is to what extent it counts as public debt. And this part of the public-private partnership, which counts as public debt, or which is a burden to the budget, would count toward the fiscal rules. And obviously the intention pursued here in the coalition treaty and already implemented in Hessen is to leverage public debt to the extent that it leverages private investment. But from the fiscal rule side, there's no issue with such instrument.
There's something we might be discussing, which is related to that, which is the legacy of the Juncker plan. The Juncker plan was, in a way, public-private partnership because it's the de-risking of investments through guarantees of the EU budget managed by the European Investment Bank, and where there is some public component in de-risking investment. So you could say that, especially the green transition, may imply more of it. And the question is, how should it be done? It's not something we're addressing, but clearly the solution that was found for the Juncker plan was a very temporary particular one, because it was there were some leftovers in the budget that were used for that. So you could say perhaps that's something that should be investigated in real scale. Okay, I don't see any other questions on the chat. Jeroen Zettelmeier, we should answer this question. Question for Armin. Can Article 123 be the basis for EU emergency spending on a common rather than idiosyncratic member state level emergency like climate change?
Well, this is uncharted territory, Jeroen. As you know, as among economists.
Sorry, it's Article 122, right?
Not 20, yeah.
Yeah, he's asking 23, so he's asking monetary policy to engage.
No. He says Article 122. This was a typo.
Yeah, okay. Different. The 123 would be interesting to talk about climate, ECB climate policies, and Article 122 is solidarity. Well, if you can make the case that climate issues are tantamount to exceptional occurrences in the terms of the treaty, you could certainly design a facility that would respond to a climate shock. Let's say you would design it in a way that if climate disasters occur, heavy rains, heavy natural events, which then would compensate for the damages that come with these events, you would certainly be able to make a case, well, this is an exceptional occurrence within the meaning of 122. Going beyond that to finance generally climate issues, we would have to explore this more deeply, because it's less of an insurance mechanism. It would be more of a permanent financing instrument. However, on the other side, it is, as we know, climate is something exceptional in its overall macroeconomic dimension. So something that is not easily to answer.
Well, Armin, I would say that climate is both investment, but it is also risk. So to the extent to which we have to insure us against future risk, it could be envisaged some kind of insurance mechanism, right? So, but it's just one part of the issue, right? Because so the other issue is, investing in the transition and so on.
Yeah.
But there is a pure insurance also topic related to climate.
There's another dimension in the question by Jeroen, which is whether it can apply to all member states or whether 122 applies to only one member state. Clearly, there are two paragraphs in 122, one which refers to one member state and the other one that refers more generally to the situation. But we had a discussion on that, and our interpretation, but I defer to Armin, is that it's not limited to a particular member state. I mean, it should not be read as meaning that it can only apply to a situation affecting a single member state.
Exactly. I mean, that's our view, and indeed there is a debate within legal scholarship. Some who interpret 122 very narrowly point at that the second paragraph of 122 only applies to individual member states, However, the practice shows, and the way of how NGEU has been designed is to look at 122 as a whole, and which then would not require that only a specific member states would be hit by an event, but it can also be as a mechanism addressing all member states.
Yeah, the legal construct of NGEU builds on 122 without distinguishing between paragraph 1 and paragraph 2, right?
Absolutely correct. Yeah, it does not distinguish, and there are good reason not to distinguish between them, because they are all both born by the same solidarity motivation. The first paragraph has been designed so oil shocks and shocks that were by the treaty makers at that point in time still in their mind, and 122 has been designed or drafted more broadly, so they are looked at, they are considered together. But as I said, some in legal scholarship would say, well, you should distinguish between those.
Okay, so we are already over time by close to 10 minutes, so I think we should close here. There are no other questions in the chat. Let me just remind everyone that the report is now available online on the website of CEPR. And we hope that it will trigger quite a number of discussions. We are planning to publish columns and especially on Vox and op-eds on that, and really we're looking forward to the discussion. Thank you to everyone. Thank you to the panelists, and thank you to CEPR.
Thank you.
Thank you.